With more than 6,000 small and micro-cap companies listed, if you're looking for the next apple at the earliest stage, then ChannelChek truly is the orchard. The listed companies support ChannelChek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for ChannelChek so you're always up to date on what's going on at the small and microcap data place. Welcome to the virtual Roadshow series presented by ChannelChek. This Roadshow features Mark Marinko, CFO of Lakes Dredge Dock Corporation, NASDAQ ticker symbol GLDD. Following a formal presentation, he is joined by Fratt, Senior Research Analyst for Noble Capital Markets, a FINRA-licensed SEC-registered broker-dealer, for a Q&A session featuring questions that were submitted by the live audience. You can find Noble's research on Great Lakes Dredge Dock on channelchek.com or by clicking the link in the description. With that, I am pleased to present Mark Marinko.
Great Lakes Dredge Dock is over 130 years old. During the pandemic, we were deemed essential critical infrastructure. So we worked the entire time during the pandemic. We are work domestically here in the U.S. as well as international. We're actually the only domestic dredging company that's had an international presence. We do multiple types of work, capital, coastal protection, port deeping. I'll talk a little bit about all of those as we go through the presentation. And important to us is safety. We have an incident and industry injury-free. We're an industry-free company, so it's an IIF company. It's a methodology that we use to keep all our employees safe as they work in this environment, and it's probably our #1 priority, and we're the best in the industry at it. A little financial here information. Our trailing 12-month revenue as of March 31 was $694 million, EBITDA 117 million, and our backlog at March 31 was $486 million. A little bit more about Great Lakes. We are the largest provider of dredging services in the U.S. and importantly, we are a Jones Act company. So our industry is protected by the Jones Act, meaning that international competitors cannot come into the U.S. market. What that means is you have to use U.S. Built ships, U.S. flagships, U.S. crewed ships, and be owned in the U.S. So I mentioned earlier, we have a long history of performing significant international projects. No one in the U.S. has that. And an important competitive advantage for us is our large and diverse fleet. And as we go through this, I'll talk a little bit more about that. Our clients, our #1 client is the U.S. Army Corps of Engineers. They're about 80% of our revenue. The reason for that is the U.S. Army Corps of Engineers are responsible for all the navigable waterways in the U.S. But we also do work for U.S. state governments, local governments, international governments, and private clients. And we have about 1,200 employees. As we look back to 2020 a little bit, we made a number of important announcements in 2020, and they're here on this slide. We did sign a contract to build a new mid-size hopper dredge, about 6,500 cubic yards. We've already started the construction on that. It'll be ready for service in the first quarter of 2023. We also announced a stock repurchase program last year. We believed at that time the stock was undervalued. You know, it dropped through the pandemic. We just had reported some record earnings, and we put that in place back then. That has now expired as of May 1, 2021. We also announced we're going to move our headquarters to Houston. We've been in Chicago for the 130 years, but at this point in time, Great Lakes, we can't work in the Great Lakes where we originally started. That's all set aside for small business. Most of our work is done in the Gulf Coast, or on the eastern seaboard. So we decided to make the decision to move it to Houston. That gives us better access to talent that's in the maritime industry down there, as opposed to Chicago area, as well as it gets us closer to our clients in that Gulf region there. And we also added on top of the Houston headquarters, we also put in some regional offices. One's in Houston, one's in Jacksonville, and one's in New York, all again to get closer to our clients in those areas. And then one additional communication we had last year that's very exciting is we are designing, not building yet, but designing a subsea rock installation vessel. And this vessel would be used in the new and upcoming offshore wind industry to the US. So this would be an entirely new industry for Great Lakes, new clients, new revenue stream, and it's a market that looks like it'll be coming as early as Q4 2023 or into 2024. So we haven't committed to construct the vessel yet, but we are working on the design of that vessel. It's going to be the first U.S. Jones Act subsea rocks installation vessel. Let's talk about kind of our markets and the work we do. A lot of details on this page, but we do a lot of different types of work. A lot of people think dredging is just going through and getting the silt out of a channel, that is something we do, but we also do a lot of other things. On the top left, you can see capital. That's about 46% of our revenue. What that is we're doing a port deepening, for example, where you are taking the channel from a depth to a deeper depth. So for say from 42 feet to 48 feet. The reason they get deeper are as ships get larger, they need a deeper draft to get through the channel. We also do coastal restoration, land reclamation. All these items live in this capital area. These are the most complex types of projects that are done here in the US or even internationally. And they're generally higher margin for us. Due to their complexity, there's few competitors, and we really love these types of projects. And they're generally the largest types of projects from a dollar value. To the right of that's coastal protection. That's a good picture there. You can see we're replenishing and rebuilding a beach. You can see part of the beach is where it's wider. That's where we've worked. The skinny part, we haven't got to that part yet. A lot of work around this. We love this type of work as well. And with what's happening in climate change, where you're having more frequent storms, more intense storms, they're wiping out the beaches on a more frequent basis than would usually happen. And then down at the bottom is maintenance revenue. That's where you just take the silt out and leave it at the depths it was. That's the easiest type of work that we do. We have foreign work. Right now it's fairly small for us, but that can be large. We've worked on large projects such as the Suez Canal a few years ago, Wheatstone in Australia, been in Europe. But right now that's most of the work that we do is in the US. And rivers and lakes is a small piece. These are smaller dredges that work inland on larger rivers and lakes like the Mississippi. It's where we wouldn't do small things like the local Gulf Pond. These are large rivers and lakes in the US inland, but those are smaller dredges. And in that pie chart, got this recurring nature of work. It's about 55% of our revenue. What that means is Mother Nature comes in, either fills an area with silt or erodes a beach or those types of things. We have to come back and do that work. So Mother Nature causes this recurring nature, but it's not your typical recurring nature like you'd see in a contract. You might come back once every year, might come back once every 3 to 5 years. Next slide. This is our fleet. This is really important from a competitive advantage standpoint. There are 3 different types of dredges. There are hopper dredges, mechanical dredges, hydraulic dredges. The key to this is you put the right type of dredge on the right type of project, and you can generate the best type of return. And in all 3 of these categories, we have either the most powerful dredge from a production standpoint, or we're tied for the most powerful productive. And that's what gives us a big competitive advantage. and we do have the most vessels in the US. On the next slide, these are just recent awards over the last few years. But point here is we do a lot of different types of work, whether it's coastal protection or capital or maintenance. We win all these different types of works, and generally, when you talk about as I was saying earlier, the most complex, largest jobs, we like those the most. We're good at them, and we win a lot of those. You can see probably the largest one on here near the bottom there, Jacksonville Port Deepening at $210 million. Those are the types of projects that we're really good at, and we can generate really good margins. And it has a lot to do with our fleet that we have, as well as our long-term expertise of doing this type of work. On the next slide, let's talk a little bit about why Great Lakes has these kind of competitive advantages and what's going on in the market here. We'll go through about these 5 different areas to give you some flavor for Great Lakes and how they work in this dredging industry. So as I said earlier on this slide, you can see we're the largest provider of dredging services in the US. There are competitors here, which I'll get to in a second, but there's only a couple of national players. The other ones are more regional. We are the only company in the US that has had international operations, and that's important because there are some large competitors in the international market, mainly in Europe. And we learned a lot of things as we worked internationally and brought those back to the US. And we've been the market leader for decades here in the US. So picture now on page 14 here of our competitors, our domestic competition. You can see we have about a 37% market share. That's on a 3-year average. Weeks is second, about half our size, and Manson about half their size. The 3 of us are really the national players. As you move more to the right, they're more regional players. They can compete on larger projects as long as it's a project that they have the right type of equipment for. There are some projects, for example, I was mentioning, Jacksonville earlier, or a project like Charleston. You may need multiple types of dredges or all 3 types of dredges that I mentioned earlier. And some of these regional competitors may only have 1 or 2 of those types of dredges, so they can't even bid on those projects effectively. But we've been in this state, as I've said earlier, for just in the market share lead for decades. Let's talk a little bit about the market for us here in the US and some of the market drivers. Our market has been about 1.8 billion for the last 3 years. Prior to that, it was about 1.2 billion. So the market has increased over the last 3 to 4 years by about 50%. And here's some of the reasons why. First of all is the Panama Canal was deepened. That we required every major port in the US to be deepened to take in those deeper draft ships. It started in 2015 with the Port of Miami. It has a number of years to go. I would tell you we're in about the 4th inning of this cycle. There have been deepening cycles forever as ships get larger. This one's a little bit bigger. So there's some have been completed, like Miami. Others are currently beginning or in the throes of being completed, and others haven't even started yet. The next one is Gulf Coast restoration. This is related to the Restore Act, where the fines that BP had to pay related to the Deepwater Horizon spill. Those fines are required to be used for Gulf Coast restoration, which dredging is a piece of that. For example, there are barrier islands out in the Gulf. That's where these barrier islands sit maybe 10 miles offshore. They reduce the force of a hurricane as they come through, but over time they erode, they have to be rebuilt, and that's work that we do and our industry does. And then another piece here is the last one here is the Werta Act and the Harbor Maintenance Trust Fund. the Harbor Maintenance Trust Fund is a big piece of funding for the Army Corps and the work that's done on these ports. What it is ports come in, ships come in, pay a port tax. Those taxes are required to be used for port maintenance. In the past, only about 50% of those were used for port maintenance. The rest was siphoned off to the rest of the government. President Obama signed into law that 100% of the Harbor Maintenance Trust Fund needs to be used for port maintenance. And at the time he did it, needed to be done by 2025. It is now at 100% now. So that's additional funding that we didn't see a few years ago. Let's talk more about our fleet. I think the fleet is really the guts of what gets the work done for us and drives revenue for our company. And it's important, as I said earlier, to have the most powerful and productive fleet, as that's what allows you to generate the best margins and compete effectively on projects. We've added recently the Ellis Island. That's the largest hopper dredge in the US that came online in 2018. The Dredge 58, that's a clamshell dredge. We bought that from a competitor in 2019. We upgraded the Ohio, which is a cutter dredge. It used to work in the Middle East, and we brought that back here to the US last year. And now we're building this new mid-size shallow draft hopper dredge. Different than the Ellis Island, since it's shallow draft, it can get really close to shore and either pump sand on a beach if we're rebuilding a beach, or it has a short pipeline to pump it on the beach. Gives us a big competitive advantage. This is the largest size dredge at this draft that you can build. But all these changes are for us to expect us to, improve our competitive position, improve our market share, and improve our operating margins. And it's important to keep our, competitive position. Next, on the next slide, this is all completed now, but it's a really important piece. If you go back and look at our financials from, let's say, 5 years ago, we did a restructuring program, announced in 17, really completed it by the end of 18. We took 40 million of costs out of the business permanently. We took out G&A and overhead costs. We reduced third-party costs, but what we also did was rationalize some of our older, underutilized pieces of equipment. We took out about 100 pieces of equipment. About 6 of those were large vessels. The rest was ancillary. We call it ancillary equipment that works with the dredges. But by doing that, we improved our position from a financial on the P&L side by about 40 million, and it's been permanent and really changed how our financials move from 2018 to how we look today. A little bit about the management team. Lasse, unfortunately, couldn't be here today, but he came on as CEO in 2017, but he's been working in the maritime industry, oil and gas sector for over 35 years, so he knows the maritime world well. Dave Simonelli, our Chief Operating Officer, he's been with the company for 40 years. It was really his first job out of college. He's everyone in the industry knows who he is. He's a legend. He's been great. Has the great experience and knowledge on any type of dredging operation. I've been with the company almost 7 years now. Vivian Schiffer, she's our Chief Legal Officer. She actually came onto the company last year, but's been obviously a lot of experience in the legal world. And James Testard came on as the head of human resources in 2020 as well. But again, 30 years of experience. So you've got a well experienced management team. And when you look at under Dave Simonelli, many of the people in the company and operations have been with the company 30, 40 years. Okay, let's talk about the financials a little bit and kind of the changes we've seen over the last few years. So from a revenue perspective, revenue increased to a record for us in 2020 at 734 million. You can see the 694 trailing 12 months dropped a little bit in this quarter this year as we had a record first quarter of 2020. It was our best quarter ever. This quarter is just a little different. We had some vessels in dry dock this quarter. On On the adjusted EBITDA side, you can see this kind of hockey stick as when you start looking from 2017 and you move forward, you can see the restructuring that started to, majorly improve our results in 2018, 2019. We've got to, again, in 2020, a record EBITDA margin of 150, EBITDA of 151 million, record margin as well at 20.6% on EBITDA. And again, a little drop in the first quarter of this year, as our first quarter of 2020 was just a blowout record, tough comp. Down at the bottom, you can see our capital expenditures. The company generally spends about 35 million a year on CapEx every year just to keep our fleet in class. You're required to do regulatory dry docks. Those are reviewed by the Coast Guard to keep the vessel in class. We spend about 35 million to maintain the fleet. The difference is there in the darker shade show you some of the investments we're making. If you go back to 16 and 17, that's when we were spending a lot of money on the Ellis Island. That came online in 18. We didn't have any more payments in 18. As you kind of go now into 2020 and 2021, you can start to see the investment we're making in the new, generally in the new hopper dredge we're building. But the base CapEx is about 35 million a year. Everything on top of that would be new investment. Quick on the first quarter numbers. As I said, we had a decrease in the first quarter, but I would say the first quarter is looks very similar to the prior three quarters. But versus first quarter of 2020, we had a drop in revenue, profit, and EBITDA, but only because those were really fantastic numbers in the first quarter of 2020. In the first quarter of 2020, we had no vessels in dry dock. Every vessel was working. It was really just a grand slam quarter. In this quarter, you can see we did have some vessels in dry dock, but we were also impacted by COVID costs. We had about 4.3 million of COVID costs. That's been the highest. We had an outbreak on a few vessels. We were fairly immune to it in 2020, but as there was a spike at the beginning of the year after Christmas, we saw that spike. But good to say that spike is gone now. All the vessels are working, and with everyone getting vaccinated, it's ebbing in the country, and it is ebbing at Great Lakes as well. So key for us is to keep those vessels working and to get everyone vaccinated so we don't have that type of disruption. As we look at backlog, backlog has been in this kind of 500, mid 500 range. We're at 486 at the end of first quarter 2021. There is a natural dip in the first quarter. It's actually, we have a backlog that's a little bit higher than March 31 of 2020. The reason for the dip is it's a low bidding season. In the first quarter, we have seasonality to our bidding, which then when you win a bid, it adds it to backlog. Our big bidding quarters are second and third quarters, the largest. That's the fiscal year end for the Army Corps. So we generally see backlog tick up in Q2 and especially Q3. One anomaly is in 2018, we won a deepening job right at the end of the year for about $200 million. So if you took that out, that would be about in the 500 million range. But we've had this good solid backlog, and it's really related to those market drivers that I talked about earlier, this increase in market to this $1.8 billion number the last few years. And then there's just on the appendix a net income to EBITDA reconciliation. But otherwise, that's my presentation, and looking to open it up for questions.
This is Poe Fratt with Noble Capital Markets. Thank you for joining us. Great presentation, Mark. Can you, I guess first off, just one question that's come in is about the stock buyback. And
Sure.
It did expire, you said on May 1st. What are your thoughts on, one, why you didn't use or utilize much of the stock buyback? And then secondly, could we see another one implemented at some point in time?
Sure. So first of all, when we put that share repurchase program in place. It was the end of April last year. And the stock was sitting at about, I think, $8.63 at that time, right about that number. We had, about a month or two before that announced record earnings. COVID hit, knocked the market down. We believed the stock was totally undervalued, and we put in a 10b5-1 plan. So we had some parameters set on certain price points we were going to buy with a ceiling. So it was well above the 863, but as things moved down and the market kind of came back, the stock shot well above the prices we had in the share buyback. So we only spent about $4 million on the share buyback, and that was early in the program. So that's the reason why we weren't required to buy much more. But as we move forward here, now that this expired, yes, if we believe the stock is undervalued, we would look at implementing another program, just like we did last year.
One thing you didn't mention is that, and congratulations for this, is, you successfully refinanced the bonds that you had outstanding that mature next year. And can you just talk about how you looked at that refinancing and how, if you could just give us some color on, just how successful it was, and then also what it does for you as far as creating a lot of visibility for your capital spending program, from a financing standpoint. Will you have to do other financings, or should this be, pretty much take care of most of the financing for the next 5 years or so?
Yeah, no, great question, Poe. I'm glad you brought it up. Yeah, no, we're really pleased with what happened. The old senior notes were at 8%. We were actually looking at potentially taking them out early 2020 because they stepped down to a 104 premium in May of 2020. So we were willing to pay the premium to take them out back then, but what happened was COVID hit and the high yield markets went the wrong way. So we said, okay, we're not going to do it now. It's not worth paying the premium. We waited till now. The high yield markets have been in really great position for a number of months now. So very pleased to say that we took them out, didn't have to pay the premium, took them out at par a few days ago, actually. And we lowered the interest rate from 8% to 5.25%. It became our old notes were a 5-year tenor. This is an 8-year tenor. So longer time horizon. So S&P and Moody's love that. We were upgraded by Moody's as we went through the process. So that was great. Hopefully S&P will follow suit. We'll see. But that lowering of 8% to 5.25% saves us almost $9 million annually of interest. And maybe even more importantly than the interest savings is the covenants in this type of debt are a lot less restrictive than our old debt. So we have a lot more flexibility to do permitted investments, permitted debt, restricted payments like share repurchase would fall under restricted payments. So our last, when we did the share repurchase program last time, we had a limit of 75 million. That was because of this debt. Now that restricted payment category is three to four times that if I wanted to do more. So if we so choose, I have a lot more flexibility to do what we need to do. So very pleased with, I thought it was a very successful outcome. From a, debt as we look forward, we still have a lot of cash on the balance sheet, haven't tapped our revolver from a cash perspective. We continue to generate, free cash flow from operations. So for the time being, I don't necessarily need to do any new debt based on what we've got when we're looking at the hopper dredge we're currently building. We're building some smaller vessels we mentioned on the earnings call, like a multi-cat, much smaller dollars, and potentially the offshore wind vessel. We can do from what we have today, but we will look at, in particular for the offshore wind vessel, there's some potentially attractive financing that's given out by the Department of Energy. We've talked to them. So if that's attractive enough, we could utilize that if we need to.
Mark, you talked about the dredging market, and, the port deepenings being driven by, the expansion of the Panama Canal. And, it seems like it's more of a phenomenon that it's the benefits are from the container market, larger containers. But in the meantime, the energy market has been sort of opened up for the US from the standpoint of, eliminating the export ban. Can you just talk about what you're seeing from the energy perspective, and then potentially even sort of, does it broaden the market, maybe geographically, more Gulf Coast?
Yeah, another good question. So, I talk a lot about the Army Corps and that being 80% of our market, but we do have private clients. And when we talk about the private clients, most of those are energy clients. They own their own terminals. You're right, Paul, right along the Gulf, like in Texas or Louisiana. And those terminals, they either add terminals and they, more slots, like call for ports, more dredging there. So we do work there. We're working on a project actually this year in Sabine Neches in the Texas area. So that is a important client, and it's been kind of slow for the last few years due to the low depressed oil prices. So we'll kind of see how that market goes. We do have 2 private client jobs that are what we call low bid pending award. We've signed a contract to do the work, but it's not in backlog yet because that project is not giving us notice to proceed. It goes through a process of sign up the contractors, then they go get financing, they get their revenue contracts, and then they give us notice to proceed. We'll see how the market will drive those, but it's good that we were the chosen dredging client for them, dredging contractor for them to do those projects. But we don't expect those 2 that we have to come to fruition in 2021, but could come to fruition in 2022 or beyond. So looking for, at least that's out there as additional potential work for us.
Yeah, but as I recall, it's north of 200 million as far as what your low bid pending award number is.
Yeah, more than that. Yeah.
Yeah, and can you, Mark, talk about the market? You did a good overview on the different types of work that you do, whether it's deepening or coastal protection or marsh creation. Can you talk about the competitive landscape and whether it's become more competitive over the last 2 to 3 years, or what you see out there as far as just the competitive landscape?
Yep. It's been, I wouldn't say more competitive, but it's stayed competitive. As we've, I said that slide where we added ships, the Ellis Island, and bought the 58 from a competitor, brought the Ohio over, and now building a new hopper dredge. Our competitors are building as well. Weeks has built a couple of dredges, a hopper and cutter dredge. We had a new entrant into our market, Callan Marine. They were more inland, but they built an offshore cutter dredge, so kind of came into our market. They won a job, so they don't take a big market share, but so I would tell you that, excuse me, the competitors have kept up with us. If they didn't, we would have even more market share based on the move we made. But so I'd say the competition is the same, but this market increase from 1.2 billion to 1.8 billion has absorbed all of this additional capacity. And we look at this kind of $1.8 billion market to stay strong for the foreseeable future.
And then when you look at the first hopper barge, hopper dredge that you're building, can you address how you're managing to, try to minimize any cost inflation you might see from some of the component parts? Mainly steel prices have moved up since you announced that. And then secondly, can you talk about, the option that you have to build a second one?
Sure. Yep. So we're fortunate on the first hopper dredge that, we signed that contract last year. In our contract, there's a little range of steel pricing where if it goes a little bit higher, the shipyard has to absorb it. If it goes a little bit lower, they get the benefit of it. And steel is one of the first things you buy. because that's where they start building the hull and the keel. And so fortunately, we've had almost no impact related to steel prices on that hopper dredge. So fortunate we bought before the steel prices increased. But when you look forward to the second hopper dredge, we have to make that decision by next summer, and it's a carbon copy of the first one. So we'll look at the market at that time to decide whether or not we want to do that. We would be impacted probably if steel prices stayed where they are today. That would increase that price for that hopper dredge. But at this point, we haven't committed to do that hopper dredge yet. We'll look at the market. I do want to be clear that this hopper dredge we're building now, we believe will help us grab market share. It doesn't cannibalize our fleet or take away from the rest of our fleet. The second hopper dredge would, so we expect it would. So that as we look at doing that build, we would maybe retire one or two of our older hopper dredges to kind of offset that.
And then when do you anticipate, moving forward on the offshore wind, rock dumping barge? How long should we expect the design process to be? And, when do you think you talked about the end of 2023 potentially as, having a piece of equipment in the market. Can you just talk about whether there are any contracts that you see or in negotiations for that? Is it too early? And I guess I missed that on the hopper barge too. Are you seeing any interest in someone signing a contract to use that hopper barge, or is it still sort of a call out market?
Yeah, so let me answer the hopper first. So, that won't be ready till the first quarter of 2023. So we'll just bid when you get about 3 to 6 months before that hopper's ready, then you start to bid for it. So it's a little ways out before we'll do any bidding on that. But for the offshore wind vessel, we are actively talking to developers right now. There are some bids that are going to be tendered soon, like in the next 30 days, 60 days, with a potential award closer to the end of this year. But that work wouldn't commence until late 23, early 24. So as we look at this offshore wind vessel, let's run a scenario for you. Assume that we tender a bid in the next 30 days, 60 days, and we then are awarded later in the year. We would have to make a commitment then to build that or construct that hopper dredge, the offshore wind vessel dredge, the subsea rock installation vessel, by the end of this year, because they do take 2 years to build. So at the same time as we are designing right now, we are talking to shipyards, potential shipyards about, okay, can you build this? Generally, what would it cost? What are we talking about? So we are having multiple work stream paths to get ready for this market.
Yeah, it seems like there's still a lot of permitting, and sequencing issues, but that's interesting that you could see a contract signed before it's even, first steel is cut.
Yeah, that is very possible.
Are you aware of anyone else considering building a similar type of, piece of equipment, Mark? Do you think, I think I listened to a recent presentation where Crowley potentially is involved in, some way, shape, or form in the offshore wind market. What do you see as far as your competition?
Yeah, so on this type of vessel, the subsea rock installation vessel, and quickly for people, what that is it's a large vessel, actually as large as the Ellis Island, actually a little bit larger, but less complicated. It carries rock bins on the deck, and it has a couple of cranes that take the rock out of the bins, put them down a conveyor belt, and down what they call a fall pipe that goes over the side of the vessel, and with dynamic positioning, specifically places the rock, or precisely places the rock around on the seabed floor around the monopile. The monopile is what goes into the seabed. That's the stand for the wind turbines. And that rock around it gives the monopile scour protection, as well as you can put it in there for ballast. In terms of that vessel, right now we're not aware of anyone in the U.S. building a Jones Act vessel for that. There is international competition that does have these same vessels. So the company that's designing it has designed this vessel in the past for international competitors. So international competitors would be our competitors here, but the way it's looking from a Jones Act perspective, there's a layer, when it's a pristine seabed, it's not Jones Act. Once that first layer of rock's put in, now it becomes Jones Act. So second layer of rock, you have to go get the rock from, if you have a Jones Act vessel, you can go back to, let's say it's a wind farm off of New Jersey. We can go get the rock from New Jersey, come back. An international vessel, well, it can't go to New Jersey. They have to go to somewhere like Canada or Norway to get the rock. So that's why we believe we can effectively compete against them. They'll have a lot longer sail time to go do the rock, but their equipment is cheaper to build because it's not Jones Act. They have a cheaper crew, but because that long sail time to go get the rock, we believe we can compete.
Can you just talk about your cost structure a little bit, Mark? And I guess the two areas that I'd love to hear about is one on the labor side. Are you having any cost pressures there? You talked about retention, employee retention, and that seems to be one of the drivers of your safety record. And then secondly, if you could talk about just how much bunker fuel or fuel is as far as your operating cost structure, and then what you're seeing or what you're potentially looking at as far as, are you concerned at all about potentially bunker fuel costs going up?
So on the labor side of it, along the East Coast, that's union labor. We have a 3-year contract, 3 or 5, I can't remember off the top of my head right now, but that's by the way, an industry-wide contract. We all have that same contract. So those are very fixed. We have great relationships with the union. Our industry does. It's a very specific union. These are people that work offshore, seafarers union. It's a type of work they love to do. They're well paid. So we don't have a lot of disruption there like you might see in other types of industries or what you're seeing from a COVID perspective today. For us, the labor issues we have, generally our employees that work on the different projects and rotate around, these are engineers, like site engineers. They come work for us out of college. They work for about 5 years. They're moving around from project to project, but after 5 years, they maybe want to get married, start a family, and looking to settle down more. So that's when we tend to lose people a little bit, but if they stay after that, they tend to stay forever. So that's always our little bit of a challenge there. But otherwise, it's been a lot less impacted than I'd say a lot of other industries that you've seen over the last 12 months. From the fuel side of it, what we do is when we bid a contract, on that date, we're bidding, we estimate how much fuel we'll use to complete the project. We use that price of fuel, and that's what we put in our bid, and then we hedge the fuel. So we hedge 80% of our estimated next 12 months fuel. And so we're locking in that price. So when I'm looking at a project as it's performing over the months, I don't have a variance of fuel, whether it's favorable or unfavorable, unless production's different, right? So not a price variance. So we lock that in. And essentially, you're essentially taking, as price goes up, that goes into our costs, which goes on to the client.
Yeah, and I guess the question also was asking about carbon taxes in the context of carbon taxes, and maybe even you could address how you're looking at managing emissions, and that the carbon tax on any fuel costs. My sense is, hearing what you just said, is you'd be able to pass that through, build it into your bidding, and so that it truly would be absorbed likely by the customer. But then also on the emission side, would you have to modify any of your older vessels? I assume that Ellis Island and the new hopper dredge will be, very, very technologically compliant from an environmental standpoint. But can you talk about how you look at that?
Yep. No, you are right about passing on a client. The way we always look at these projects are we figure out the cost to complete the project and tack on a margin. So if it's in the cost, that's how we, essentially pass it on to the client. But I'm glad you asked that question on the vessel we're building now. The hopper dredge is Tier 4 engines. As we look at the new offshore wind vessel, that one's going to be ultra low emission. The state of the art is what we're designing, but also to have the ability to retrofit biofuels. So we're looking at, as we're getting into that green market there in offshore wind, we have to be green, and our clients are demanding that. So we're building that in as we're looking at this design. When you talk about the older vessels, the most recent ones are Tier 4 engines, but there are things you can do. You can put scrubbers on the exhaust for lower emissions. But if something happened, we would have to retrofit those vessels to meet those standards with newer technology.
Well, I think we'll wrap it up there. But any parting words, any questions that you get from investors right now that seem to be on the front burner? What are the biggest concerns out there? We talked about the refinancing for a while, just because you were in such a such a strong financial position, and it's great to see that happen. But what's keeping you busy, and what are some of the investor concerns that you hear out there?
The investor concerns were a little bit about what you mentioned. What's this inflationary impact going to do to your business, whether it's steel or fuel? And we've talked a lot about that so far. Steel could impact us later on, and whether it's on the new build of the offshore wind vessel, that would obviously increase the price of that. But the other thing tied to that is they ask us about, is this offshore wind market really going to happen? It seems to be accelerating from the time frame we originally talked about probably a year ago, Paul. We've been talking about it for 18 months or so. I'll say this, they were estimating, late last year, 10 gigawatts of power in the Northeast. Biden came out in March and said he wanted 30 gigawatts. Aspirational, but the point being, they want more. We're looking at tendering bids a lot sooner than we originally anticipated. This market looks like for where we want to play in this subsea rock installation, and there is dredging as well. The things we do today as part of that market, that's going to looks like more and more like, it's coming in 24. It doesn't look like it's sliding to the right now. So we're very excited about that market, as it's not just, the new clients, new revenue stream for us, and the company, we all rallied around it. Exciting to be doing some things that are really environmentally friendly, getting into this green market. So that's what people have been asking me lately on these calls, on top of the refinance, which now they've stopped asking. But that, as I said earlier, very pleased, and we thought it was really successful.
Thank you for joining us for this virtual roadshow presentation brought to you by ChannelChek. View our YouTube channel for more video content, including C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and 6,000 other small and microcap companies.